Our first guest we have for the hour, we have David Semmens, economist of Standard Chartered Bank, and he joins us now from London. David Semmens, good to have you with us.
Good to be back, Pim.
All right, David, so tell us about the jobless claims report. A little bit higher than many economists had previously expected, 381,000. But if you look at the 4-week trend, the monthly trend, that's good news. Tell us about it.
Yeah, exactly. I mean, it's good news. It's the best. December's looking like it's going to be the best month we've had since May 2008. So you've got to feel encouraging, because obviously then the situation was getting worse, whereas now the situation's getting better. And this is showing that the shift is really moving away from firings and hopefully back to hirings. We're hoping that the new year you're going to start seeing more evidence of hirings. And we're looking for them to break the 350 mark. Once you break the 350 mark in initial jobless claims and you persistently break it and stay below it for sort of 3-4 weeks, and I think people are going to take a lot of encouragement from that.
All right, well, we're at 375. If you take a look at the monthly average right now for jobless claims, add in the Purchase and Managing Index coming from Chicago, also positive news.
Yeah, I mean, the data is ending the year on a high, and you have got to be encouraged, because also the Chicago number does tend to have a reasonable reasonable tie-in with the ISMs, which obviously haven't been performing quite as well as people would like. But also you've got to take encouragement from the smaller businesses, which are showing a slight improvement in their intent to hiring. And obviously it's coming from a very low level, but these are the places where you're going to see jobs needing to be created.
All right, let's talk about the third leg of the stool here today. Pending home sales, also higher than previously expected by 7.3%.
Yeah, again, much better than the market was looking for. People were generally looking for quite a weak number because we had the strong number in October, but you've seen it pushing through, and it looks more now like the data is showing a sort of coincident event with the mortgages for purchases, rather than having mortgages being a leading indicator. So we've essentially lost the reliable leading indicator we had for pending home sales. So people are going to be keeping a strong eye on this as well, and hopefully that will mean that sales pick up going into the new year.
So David Semmens, does this mean that economists have to recast their estimates for 2012 in terms of the U.S. economy?
At this point, no. And unfortunately, the housing pickup we're seeing is still very minor when you look at the absolute levels. The pickup that is implied from this really isn't going to change anything with regards to GDP, especially as this is coming from existing homes, which isn't really going to have a huge effect. It's new homes you want to see picking up. You want to see new homes. And also, you've seen prices in homes edging down the last couple of months, and they're now at their lowest point than they've been in a long time. They broke to a new cycle low, as we saw in the Case-Shiller earlier this month. So I don't think economists are going to be rushing to revise their forecasts just yet. I think also they're going to want to see what happens with regards to the tax cuts for, the tax cuts from on the personal side, and also if there's any more investment tax stimulus, because obviously we've got the end of the investment stimulus tax cut incentive this month. We've had obviously seeing a big pickup in the end of the year with regards to businesses for their investment, because they can expense things fully, whereas from January 1st they can only expense it at a 50% bonus rate. So there's a big incentive to get all your investment done in this quarter, and we're expecting the first quarter of next year to be pretty light with regards to investment, simply because people are such a big investment to pull it forwards.
Now, David, before the president went on his holiday break to Hawaii, of course, he signed off on that temporary payroll tax reduction. 3 months, that's the temporary amount of months. Do you expect that to be extended, and what effect is that going to have on the economy?
Well, I would expect it to be extended. The thing is, I don't really feel it's going to have that much of an effect. It's more the fact that if it isn't extended, you're going to see people take a real hit in their real income because their taxes are going to go up. And I think that would definitely be a concern for Americans at this point. I think people are essentially banking on it being extended. The fact that they've got the temporary tax increase means that they can start the new year knowing that they're not going to see their taxes increase, but they're going to want this to be nailed down. And I think people really want just to see how the year is going to play out as a whole. You don't want to have piecemeal being put together as we go forward. You don't want 2-month tax extensions, you want a whole year. And it's obviously, if the whole year doesn't get extended, it's going to be very interesting to see how accountants and people have to deal with that. It's going to create an additional administrative burden upon people. So I would be very surprised if they don't extend this tax cut.
David Semmens, what about wage growth, real wage growth in the United States? Will we see an increase in 2012?
I think, unfortunately, we're going to see very minimal, if any, real wage growth increase, simply because you've still got unemployment being too high, and apart from very specialised sectors, people can still very much pick and choose who they want to hire and also what wages they're going to be paying them. So unfortunately, real wages, unless you're in a specialist sector, look like they're going to just be staying flat. However, we don't think they're going to be going negative, and we are also looking for inflation to ebb as we go forward in the year, which will give a boost to real wages.
David, you mentioned business spending on investments because they're going to get that tax break in 2011. That goes down to 50% of a reduction in 2012. Where's that money going? Is it going into technology?
Yeah, I mean, it's going into technology, it's going into manufacturing. It's basically anyone who's got any capital investment to make has been really buoyed by this offer. And the thing is, it's more pulling things forward. But obviously, when you've got those machines coming into factories, people want to put those machines to work. So if you were thinking of expanding in the first half of next year, you're going to have already made those purchases, I would imagine, unless you're feeling incredibly cautious about the outlook, in which case you probably weren't going to buy them anyways. But that means you're going to bring your hiring forward. And so although you always have a bit of a lag between capital investment and hiring, we are going to expect that hiring is going to pick up during this year, next year even as well.
We're speaking with David Semmens of Standard Chartered Bank. He joins us from London. All right, David, you're talking about 3 economic reports today. You got the ISM numbers from Chicago. That was positive. Pending home sales, that was good. Also, the jobless claims number, a little bit higher than many analysts had forecast. But if you take a look at the monthly number, that was good. It's about 375,000. So why would people with those conditions, why would they go out and buy U.S. Treasury bonds?
Well, I mean, the main thing is people are still incredibly concerned about the outlook. And the thing is, when you look at the US compared to Europe, the US is a very strong fiscal union, whereas Europe, people are concerned about the future. People aren't worried about the US going anywhere. People don't see that, whereas people are seriously questioning how Europe will persist going forward. And we have a recession throughout Europe next year. We're looking for them to decline 1.5% simply due to financial crisis. But we are still feeling far more upbeat about the US. But again, in the US, you have no real inflationary concerns. And the growth that you're looking for is pretty minimal. We're only looking for 1.7 next year. So again, there's very little reason to be too optimistic and very little reason to to move away from treasuries at the moment. The thing is, people are holding on to them because they are very, very cautious, and they are a reliable source of income. That's the reason. That's why they are the gold standard. That's why we feel people are feeling optimistic about them.
David Semmens, an op-ed piece in today's Financial Times by Wolfgang Munchau of Euro Intelligence. He talks about 3 potential scenarios from the euro. He says a political union with a joint debt instrument, the status quo enforced by internal austerity, or a breakup. Do you see any of those happening? A breakup, austerity with the status quo, or some actual change to the political union with a joint debt instrument?
I mean, I think you're more going to be moving towards sort of just the status quo and having austerity. You've seen Italy introduce austerity measures. You've seen France raise their retirement age. You are seeing very small steps happening. And in the backdrop, you've still got Germany moving along very firmly. The export engine of Germany is still running very well and essentially keeping Europe afloat with regards to growth in that respect. And at the moment, we feel very unlikely that people want to rush into giving up their sovereignty in that respect.
Well, David Semmens, you're joining us from London. Give us the perspective of London and David Cameron, the British Prime Minister, and what people in London expect from Europe, and whether political union on the continent could cause Britain to be even less involved in European affairs.
Well, I think Britain still wants to stay very much involved in political affairs, but they're not looking for the fiscal union, if I'm reading the politics correctly. And the thing is that I think Britain feels uniquely well placed between the US and Europe, but also it's important to remember that the UK has introduced austerity measures, and they feel that that's unfortunately the medicine that everyone has to take. No one is in a particularly positive position in Europe at present, and everyone is going to have to share the pain.
Well, as an economist, David Semmens, do you think that that prescription is actually going to work? Of course, there's a body of reports dating back to John Maynard Keynes that says this is just the time to not introduce austerity. Austerity can come later, but right now you've got to get economic growth going.
The problem at present is we're 4 years, 4 or 5 years, depending on which continent you're sitting in, into a recession. You can't keep spending forever going like that. And I think the problem is a lot of countries are going to start hitting the point where their debt just spirals out and their debt to service ratio becomes unfeasible. So unfortunately, people are having to rein in their spending, and you're seeing it both in the consumer and on the government level. It's unfortunately going to be the theme for developed markets going forward for the next 5 years, I would say.
David Semmens, you talked about the status quo and that that's what we can expect in 2012 from the European Union. Do you think any countries will actually leave the euro?
No, at present there's no real incentive for anyone to leave. If you were to leave the euro, you would have to close, and you're running a deficit, you would have to close that deficit immediately. It would be very complex with regards to renegotiating the contracts, which would all obviously be priced in euros and into the new currencies, and also you'd be left with obligations in euros and having to pay, your assets being priced in whatever new currency you would be in. So at present, most countries don't have a great incentive to leave the euro.
A recession in Europe, David, how does that affect the United States?
Well, the thing is, in a way, fortunately, the US is far more domestic demand driven, so you don't have to worry as much. Obviously, it won't be passing without event, but it's not going to take too much off growth. I mean, we have factored this into our forecast, because we have as our core scenario a 1.5% decline in Europe next year. Our European economists aren't feeling particularly optimistic, obviously, about the outlook, and we have that factored in. Now, the thing is, when you look at US-Europe trade, Europe only accounts for around 20% of US imports or exports. So even if you assume that would half, you're not going to have a huge shading off of growth, because trade isn't as big a component for the US of GDP as it would be for, say, the consumer. And we would actually be more concerned about the knock-on effect on the consumer with regards to their feelings for the outlook if there was a deeper recession than we were looking for in Europe, and also a euro breakup. I mean, I think it's more people being concerned about the outlook that we are looking for, and keeping an eye on making sure that doesn't happen in the US, because obviously you've seen a bit of a pickup in the US consumer the last few months, even with the problems in Europe. People are feeling better about the US, and we think that's really coming from, it's not, I wouldn't say it's strength, but it's just the improvement in the labor force.
David Semmens, final point to you, a recession in Europe and its implications to China.
Well, the thing is, obviously Europe is now China's biggest trade partner, and that would be much more of a concern than it will be for the US. But ultimately, we're not looking for a deep recession. So we think, again, that's factored into our numbers. We're looking for 8.5% from China growth next year. So it's obviously growth that isn't as high as perhaps the Chinese are used to, but it's still far higher than we've been seeing in the US for quite some time.
I want to thank you very much. David Semmens joining us from Standard Chartered Bank from London.